Hello and welcome. You tune in to Rush Hour with me, Ankita Saxena. Well, on top of the news, the European Central Bank has cut its deposit facility rates by 25 basis points down to 2.75%. Now, the rate cut was expected by the investors. The main refinancing rate was also cut by the same quantum, down 2.9%. The ECB has still not committed to a rate cut path for the year, waiting for the inflation to sustain at the desired 2% level. To weigh in on that, we are now joined by Geoff, independent emerging markets commentator, joining us now. Hi, Mr. Dennis. Thank you so much for joining us on the phone line.
Good morning.
Mr. Dennis, this is the fifth rate cut by ECB, 25 basis rate cut. That was largely penciled in by the street. We were expecting that to come through. But tell us, we are still awaiting the commentary as far as what the rate trajectory is going to be for the rest of the year. What is the sense that you are getting? And also, given the kind of inflation rate that they're expecting, they're hoping to maintain that. Is ECB likely to take that into account? And what is going to be really the commentary? Because, usually the central banks use commentary also as a tool more than the rate cut.
Yeah, which of course is exactly what the Fed does as well. I think you've got to assume there's more rate cuts to come. I don't particularly forecast closely what the ECB does, but I'm sure you are aware that the EU announced this morning that there was no growth at all in fourth quarter GDP, which was a surprise, albeit the expectation was a very, very modest increase. So the European economies are flat as of Q4 in terms of economic growth, and that I think simply pushed the Fed even more pushed the ECB even more towards cutting interest rates today. I think there's more to go. Interest rates are now at 2.75%, and I think there's probably another 50, maybe 75 basis points to come. You've got to be careful that you don't go too low, given that inflation is still targeted at 2%. But the economy is very, very weak in Europe, and I think probably needs more monetary stimulus. So I would expect a few more rate cuts still to come.
It's a very tightrope that ECB would be walking as far as the inflation, balancing the inflation is concerned versus the slowdown in the economy. Will that impact, say, the quantum of the rate cut going ahead or the number of rate cuts? Because the Fed has already, given out that, this year we will not see 4 rate cuts, but 2 rather than expecting 4. So the Fed is already out with that verdict. But as far as the ECB is concerned, do you see a difference in either the number of rate cuts or the quantum going ahead?
No, I don't think so. I mean, I think this is probably pretty much on their plan, but it will be very interesting to see what the press conference comes up with. But I think I'd rather just leave it simply as to say that there is no earthly reason, and I think no reason why the ECB would stop at this point, given where inflation is and given where rates are. And I think to map out where they're going to go the rest of the year, I think will be quite interesting. Now, you mentioned the Fed there, and the Fed's dot plot is 2 rate cuts in 2025. I think that's going to be pretty hard to do at the moment, given the economy, given inflation, given the uncertainty about Trump's tariff and tax cut policies. So I think all of this, and I know that you didn't particularly ask this question, but I think all of this probably is going to put downward pressure on the euro against the dollar, and that's been my call for the year. So I think the ECB will push the thing in that general direction anyway, by almost certainly highlighting there is much scope for more rate cuts still to come in Europe.
Mr. Dennis, there are a couple of macroeconomic headwinds there. I mean, of course, the dollar index remaining elevated, but also there's a threat of Trump's threat to raise tariffs on European goods. That remains a major source of uncertainty. But officials have lately emphasized that the negative impact of such a move could have an on economic activity, with few signaling that it could reignite the prices further.
I mean, in theory, it shouldn't reignite reignite prices further in Europe, of course, but it could well. It's going to be a positive factor for inflation in the U.S. for sure. Now, what we don't know, unfortunately, is we just don't know how broad the tariff increases are going to be, how large they're going to be, and therefore it's impossible at this point to model what tariff increases could do for U.S. inflation. But, everything else held constant, tariff increases will boost inflation, and that will continue to put, I believe, pressure on the Fed, whatever Trump says, to keep interest rates fairly high, or at least at current levels, and at most, I think, 1 or 2 rate cuts this year, and that does put pressure on the dollar. That upward pressure on the dollar, that is a negative for the U.S. economy, because it means higher export prices. But the lower euro and the stronger dollar is one good thing that is going on for the European economies. A lot of very good export companies in Europe, and they will benefit from that weaker euro. Although, frankly, we haven't seen enough of that so far, and the dollar's been strong for a while, to offset what is a very, very sluggish domestic demand situation in many European countries, particularly places like Germany and France, which, of course, are in the middle of tremendous political turmoil.
Right, Mr. Dennis. Mr. Dennis, we're completely out of time on that one. We will have to let you go. But thank you so much for taking the time out and weighing in on the situation and the trajectory, perhaps, for ECB going forward as far as rate cuts are concerned.